with me now is a CIO who's always very, very passionate about finding different stocks, very focused on the research that he would do for that particular company, would buy it and then really sit onto it for really a long time. Manish, Sonthalia, thank you so much for taking out time for us.
Thanks for that.
Can you just firstly, for our viewers who have been trying to invest, trying to learn how to invest, just explain that why it is important to buy on a right way and then hold on to it, till you actually see the dividends coming in.
So one must first understand what does the stock price represent. First, it's pieces of business, business broken down into a whole number of pieces, and it is the present value of future cash flows of what a business is going to make over the lifetime of that company. So there is an explicit period and there is a terminal value. So our job is to find out the cash flows, and cash flows is contingent on the profits which a company is going to make. So entire time, money and energy that we spend is to understand how much money a company is going to make over the next 5, 10, 15 years. Second important aspect is whether the fruits of success of these companies are going to be shared with the minority shareholders. So herein comes the quality of management. These are the two most important things which, if a person can, through his experience and reading and research, able to master. Nobody is a master, it's a learning journey and exercise. But if you are on top of this aspect, you are broadly done.
Most of the people, whenever we talk, or most of the retailers believe that value investing is all about buying low, selling high, any valuation matrix, or maybe a contra buying. Can you just tell us that it is much more than this?
So when you do contra buying, it's a part of value investing. But if you are doing turnaround investing, investing in companies which are turning around, it's more often than not value trap. Because, as somebody has said it very rightly, turnarounds seldom turn. So, therein lies the trap. That you think that the business is going to turn around, but circumstances are such that the business does not turn around, and you end up buying distressed assets, which becomes even more distressed. So one is this style of investing. I am not really into this style of investing. Value investing, according to me, is, again, based on the balance sheet side of looking at things and on the profit and loss side of looking at things. So value investing, if you look at the balance sheet side of things, where the prices to book is reasonable given the historical valuations that with assets are there in the book, and how pricey those assets should be trading based on the earnings power of that particular company. So anyway you put things into perspective, it is all about understanding what the earnings power of businesses are, and value investing is all about that. One is growth at reasonable prices, also value investing. Then Benjamin Graham's way of looking at business is also value investing. What I have found out in my experience so far is that in India, value investing in the traditional definition of the term is more often than not value trap. For the simple reason that businesses in India, majority businesses in India, don't even earn cost of capital. So earnings power is not there. And then you try to value it at traditional value definition terms, price to book, price to earning, low price to earning. It won't work. Earnings power of businesses in India's context is all about growth at reasonable price investing, GAR. People call it growth investing, but I think this is basically value investing in India's context. And this is what we try to follow.
Just as a fund manager, you manage a lot of money. What's the starting process? How do you essentially reject a company? And then when you're looking at company, how do you proceed?
So our rejection rate is very high. Traditionally we are having a focused approach in terms of portfolio selection, 20-25 stocks. So obviously if something has to come in the portfolio, it must be chosen quite well so as to move the weakest link in the portfolio out, and then this guy comes. So I think the starting point is whether the particular businesses fall within our circle of competence, whether we understand enough about those particular businesses, and then they should have demonstrated some track record of profitability, or efficiency of capital. So in fund investing parlance, it should be 15% return on capital employed. That is a starting point to look at businesses. Then whether those particular businesses have an upside in the overall trajectory of the company life cycle or the product life cycle. So how much supernormal profit a business is going to make over cost of capital, given the point its starting point is 15% return. So how much elevation it could see into a return on capital employed.
So, basically if you look at, say if somebody is evaluating a company, if there is a greater than 14-15% ROE, then you also have to do some marketing analysis. What is the competency of the company? That's what you're trying to say?
Yes. So it encompasses a lot of things. So what you are suggesting is basically comes a bit later. The scuttlebutt approach to investing and 360-degree overview as to whether the company can double their profits in 3 to 4 years. This is what I look out for when I talk about growth at reasonable price investing. Whether the business can double their profits in 3 to 4 years, because again profits is a proxy for cash flows. Whether 1 rupee of capex throws out more than 1 rupee of cash over the life cycle. So these are good and great businesses. Whether the management quality is good. Again, you have quantitative methods to ascertain that, qualitative methods to ascertain that. And then last is basically whether you are having some margin of safety between the price that you are buying the script for and what the value of the script is going into the future. So starting point is existing businesses. We are not venture capitalists. We are not angel investors. They must have demonstrated some track record. 15% return is thumb rule capital required for starting any business in India. So they must earn that bare minimum cost of capital. Beyond which, how much more return on capital employed it can earn over the life cycle of that particular company. And then, live through the entire journey of the supernormal profits, and then to take a call when the company or the product is about to go through a decline phase. So living through the entire company life cycle is what we try to observe.
You all were one of the early investors in Eicher. Can you just tell us that, what was the thought process? How did you identify the industry, how they will grow? Because it's a very competitive industry, but Eicher itself is different. So what was the thought process? It's not an industry which was, growing up. It was an industry which was discovered. There was already a lot of competition. So what was the thought process?
So first of all, we must try to understand what is a good business and what is a bad or average business. Motorcycle business is a very good business.
Right.
Whether it be Hero, Bajaj, TVS, it's a very good business. For the simple reason that the amount of capital that you put in and the payback period for that your capital invested is very, very low. In the case of Hero, maybe it is less than 2 years. In the case of Eicher, in today's context, it is less than half a year. So input output in terms of capital employed vis-a-vis the payback period in which the business pays you back that pay, you must be only sure that the company's product is going to sell. Simple as that. I think the look and feel of the Royal Enfield Bullet Classic 350 was very good. But our starting point was not the motorcycle business. It was the truck business, where they entered into a JV with Volvo. That got us excited. That got me excited. We were one of the earliest entrants into this. But then the truck story didn't play out as expected. They were changing the entire way of going about doing business in the truck side of things. On the other hand, the motorcycle business, Royal Enfield, started to scale up from 50,000 units per year to 1 lakh, then 1,75,000. Today they are at 6 lakh units. So,
you said that management, or will they share with the minority shareholders, is one of the most important things. Say if the company has a track record of 5-7 years. Let's take Eicher for example. A lot of people may not have access to the management, at least our viewers may not have. Any quantitative methods that you would look at to see a high dividend payout, low capex? What are some minor ratios that one should just look at?
See, first of all, what you are saying is absolutely right. How do you gauge the quality of management? When you are dealing with young companies or fledgling companies where you are about to take a stake. So use some of the methods, and one of the methods is basically cash flow from operations divided by EBITDA. That gives you an idea about whether the EBITDA that is generated is backed with the cash flows. Then whether there's significant fluctuation in other income, on a yearly basis. if you have something of that sort, then managements are trying to smoothen out things. Or there's a change in depreciation rates. Whether everything is going about to just to set the look and feel about the P&L account looks good. These are some of the quantitative. There's no hard and fast rule as to what can be followed. But other methods would be whether share warrants are being issued at fair prices vis-a-vis whether management taking advantage of to benefit the promoters. So these would be some of the methods that we use.
But these are definitely a basic check which any investor should do.
They should. I mean, they should, because in India's context, if you're investing in mid-cap stocks, at the end of the day, numbers don't lie.
Right.
And if you have methods, and you can play around with numbers, right? So these, if they are matching, if the maths add up, things are okay.
Right. You just spoke about a mid-cap space or the mid-cap stock and how things can be different. Say if you are evaluating a Bajaj, which you have, or a Eicher, which is now a large cap, versus a mid-cap, what will be the margin of safety? What will be the difference in the approach for a very large cap, well-discovered company versus a mid-cap company that you have just started to look or is just starting to show good numbers?
Sustainability of the good numbers. To beat established players in the business is a tough call unless you have a differentiated product, differentiated technology, or differentiated distribution and marketing. If you don't have either of them, it is very difficult to throw out incumbent players. And then if there is an industry growth, it's going to benefit the entrenched players more. So what I look out for, whether the mid-cap space or the large-cap space, given the overall context of things, the products, where the businesses these companies are in, whether the company can double their profits in 3 to 4 years, and what is the price I am paying for that growth, and whether that growth is going to be sustainable. And to answer that question, one must understand whether the competitive advantage of that particular business or company is structural or cyclical. If you are able to come to some definitive conclusion about these things, you will be able to take your call.
I remember, talking to you about a lot of companies which you had given very exorbitant targets. Some of them have happened and they have gone beyond that. So, say if you buy a company at 1,000 rupees, you believe the stock will go to 5,000, profits have doubled in the next 4 years. What is the conviction to hold on? At 5,000 is not a cheap stock. People know about it, but still holding on, still looking at it. So, what is the continuous evaluating process that you do?
See, investing is not about getting rich quickly. This is the first thing which anybody who comes to my fund must understand. I don't promise them to make them rich very quickly. It is not in my hands. So, investing is about a journey. You have to participate in a journey. If you participate in a journey, there will be periods where you have steep rises, there will be periods you have stagnant or horizontal straight line in terms of returns, you have marginally declining, but ultimately the direction is on the upside. So, if the market preloads the return given the fundamentals, then be prepared to hold that stock and see through the stagnation period in terms of stock prices. Therein where comes the challenge. Most investors want to flip and choose something, a new stock. You have to get into the groove of the business. Flipping around stocks doesn't ensure that. If you are throwing out an established company which you have in the portfolio, you know a lot more about that business than the ordinary men on the street. But if you flip that, just because it's going to through a stagnating phase because of the growth has been rewarded front-ended, and after some time you go through a time correction, and then the second phase or third phase or fourth phase of that growth, as far as the stock prices are concerned, will come in the portfolio. Most people are not wanting to stay with it. So, living through the entire journey is about patience, and this is the rarest of what people have. And it is very true that in investing, wealth moves from the active investor to the passive investor. So, if you are in a hurry to get rich very quickly, I'm sorry, there will be somebody else who exercises much more patience, will get rich at your expense.
Right. So one has to identify the correct stock, the growth rate that they are there, and then hold on to that.
Yes.